Welcome to Pirates of Finance. Unfortunately, for those looking for us live this week, due to scheduling, travel, etc., we had to pre-record. So hopefully you still enjoy it anyway. Once again, let me give the disclaimer: this show is for entertainment purposes only. This is not financial advice in any way, nor does it represent Corey and I's positions. Find yourself your own financial advisor and do your own due diligence. Hopefully, that covers about everything. And then Corey, as he's yawning there, I want to start with...
Before we even go into anything, Jack, we gave you a full week to figure out how to do the pre-roll.
Yeah.
I thought he was going to insert it after, so I was giving him a break on it.
We can.
That's good.
Here, we're going to play the pre-roll now.
Yeah.
There we go.
But I am gonna miss the comments in our chat when we are live because they are hilarious. But currently, Corey is coming from an undisclosed hotel room at the ETF Exchange conference in Miami. So, Corey, how's the conference going? What have you learned? I'm sure tons. I'm sure you just taking copious notes.
Yeah, let's set the table with expectations for this video. This is the fourth day of a conference, and I haven't been to a conference in, I think it's like 2.5 years. So this has been, for lack of a better phrase, a complete boondoggle. I don't think people are actually attending anything. It's just everyone's running down hallways, giving high fives, seeing people they haven't seen. I'm pretty sure COVID variants 1 through 19 are here, passed around frequently. Yeah, it's been fun, and also a reminder why I try not to go to conferences anymore.
Yeah, I think everybody's just excited to be IRL again. And when I was just in Miami at the end of January at the Fontainebleau as well for like the alternative hedge fund week, what surprised me was like everybody was wearing like dark suits and everything. I was like, I thought we changed, but
suits are back.
I thought looking at the ETF Exchange on Twitter, it looked like all the photos where you guys were much more casual and having a lot more fun than we have at Alternative Week.
No, I would say the majority of people, because you've got like this interesting dynamic at an event like this where you have the service providers, where you have the market makers who are there in service to the ETF issuers, and then you have the ETF issuers there who are in service to the financial advisors. So you sort of have the whole chain of people, and then you have asset managers as well. And basically, like, you have everyone dressing up for whoever they're servicing. So some of the financial advisors who don't have any clients maybe were a little bit more casual, but it was still like business professional dress code, or business casual was accepted. But as I told you yesterday, I was in a 3-piece suit, which I haven't worn and I can't even remember how long.
Yeah, but that's because you're just trying to start totally flex on everybody.
Absolutely. It's actually, I'll tell you the real reason. It's because all my other suits are in storage after I moved. Everything's in Los Angeles in a storage bin somewhere.
There's nothing better though when everybody's casual wearing a 3-piece suit. It's like when it's the contrarian move. Like if everybody's wearing suits, it's not that fun. But like when everybody's not wearing suits, that's when it's fun.
Yeah, until you go outside and it's Miami and you're in a 3-piece suit. That was a real rookie mistake. I will tell you the weirdest dynamic is, right, all these issuers and sponsors, right, beyond like the booths that they normally do at a conference like this, they have like cabanas out near the pool, but you have all these families on vacation. So you have like these dads just roasting and toasting in the sun, drinking way too much beer, and you're sitting at the JP Morgan tent trying to talk to the market makers, right, while you're watching all these like little kids peeing in the pool. Like it's mayhem. It's mayhem.
Corey, I got in the financial world now. What's hot? Like, are people wanting to sell volatility, buy it? Are they just want to focusing on low fees? Do they want like a blend, hedges?
Yeah.
What's going on?
The ETF world is always a little different, right? Because it's the alts conference. You can talk a lot more about all the things that can be done in the spectrum because you have much more flexibility in a hedge fund structure. In the ETF structure, you're talking about a 40 Act vehicle with typically pretty limited mandates, a little flexibility on leverage and derivatives use most of the time. So I would say that there's definitely an increasing buzz around ETFs that are using options in some way. Like, we've seen a tremendous amount of growth in the industry, not only for products being offered by folks like Simplify, where it's very, I hate to use the word vanilla, but it's equity plus some long put or long call exposure, but also for folks like Innovator, who launched buffered note style ETFs, sort of taking a point-to-point return outcome objective, buying a downside put spread. making it zero cost by selling an upside call. Those sort of products have really grown in popularity. And I think there's this blend that's required when you're talking about a 40 Act vehicle like that it has to be simple enough for most financial advisors to understand and clearly communicate to their clients. So getting into like the real nitty gritty of any complicated derivative solution just isn't going to work for a vehicle like that. So most of the trends are simplistic relative to some of the more fun stuff that we might chat about here or on Twitter, because it has to be productized.
Yeah. Jack, by the way, maybe it's just my quality of my headset, but I can hear your breathing again. I don't know.
Or is that
while we're
me?
talking.
Or am I breathing heavily? I will tell you that
it's-
actually, one of the things that came out of this was Cathie Wood was here and I guess reiterated her call, or she's now saying that they're seeing
she re-upped it.
50%. Yeah, 50% annualized. But here's what confuses me. She said 40% last fall, right? And now her fund has been pretty much cut in half since then.
Right.
And she only upped to 50%.
Yeah, I was thinking the same thing.
Which means that she's actually lowered her expectations.
Exactly.
Even though the number's higher, if I'm doing that math correctly.
I think, Corey, it maybe was like a not a 50% drawdown, but a 42% drawdown, and then also 10% 1.1 to the fifth power is like, you get in that neighborhood.
All right.
But if I was, I thought the same thing, Corey. If I was like, if I was her to get out of that trough, I would have like re-upped it like 70-80%. Like, why not like annualized to get out of that drawdown? And you were talking about derivatives exposure and ETFs as well. Is it me or did I see a photo? Did MEB do a tail ETF?
Oh, yeah.
As like a door stopper? Like it was like your do not disturb.
Hold on.
I gotta see this. This is unbelievable. This is brilliant. This is so smart.
All right, so this is a great example. Love MEB. This is not a product shout out, but I thought this was a fun example of like, the type of marketing people do at a conference like this, but also how things can go horribly wrong. So stock market keeping you up at night, tail. Well, if you don't know what tail is, if you don't know it's an ETF, what tail in theory is the ETF is it buys, I think 90% of the portfolio is intermediate term US Treasuries, and 10% they buy a ladder of at the money put options. 12 months out, I think they let them roll almost a full 12 months, and they're doing that every month. Anyway, so that's tail. If you don't know what tail is, though, you might misinterpret this not as an ETF, but as perhaps some sort of sexual reference. So there was someone who's very well known on Twitter who didn't know what tail is and thought this was saying like hook up to help fall asleep, and like posted a screenshot of that on Twitter, and MEB had to like go find the person and be like, you need to take that down. That's not at all what I'm trying to say. So marketing can go awry.
A different kind of service. Yeah. I thought it was brilliant marketing, but then like you said, you didn't think through all of the potential consequences, which is everything in life, right?
Yeah,
exactly.
Absolutely.
So you've had, even though you've been obviously very busy with this conference, you've still been on Twitter as you usually are. And one of the things that was annoying you this week was the high yield.
Annoying me. Yeah,
exactly.
All right, this is good. So let's get me chatting a little bit out of the way from the get-go, and then you can take the rest of this because I am exhausted. But let's talk about this high yield thing. Somehow in the same day, and Jack, I know you hate this, but somehow in the same day, I saw like 4 or 5 large Twitter accounts post a picture of HYG's equity curve. So just basically plotting the price and showing that high yield was making new lows and saying high yield bonds are leading the way. This is a sign that equity markets are going to go down. And there were 2 major things I noticed. First, a bunch of them were plotting the price return of high yield of HYG. You can't plot the price return of a fixed income index. You really shouldn't plot the price return of any index. You need to plot the total return, which takes into account distributions, but that's particularly important for a fixed income product because 100% of the return should basically come from the distribution over time. And so if you think about high yield minus the coupon income that you're earning, well, all you basically have is short-term price fluctuations from credit spread changes and interest rate spread changes, but also defaults. So that like price return should actually decline over time because you're taking credit risk. So if you were just to plot price returns of high yield over time, it would be like flat to negative. So a dumb thing to plot anyway. But two, and this is like the one that really annoyed me, is they're saying credit is losing value, and therefore that's an indicator of poor economic health. And what they were in the past trying to show is that they were using HYG to say people are requiring a higher credit spread. When high yield bonds go down, it's often because credit spreads have gone up. But what they failed to realize is that high yield bonds were dropping this year, having almost nothing to do with credit spreads, which sort of point to point beginning of the year to today really haven't moved much, but because interest rates have gone up. So it had nothing to do with sort of any view of economic health. They could have just plotted, 3 to 5 year US treasuries and tried to make the same point. Trying to make the point with high yield bonds was irrelevant because the movement in bonds had nothing to do with the feature of high yield bonds, which is the credit sensitivity.
And then there's two things. One, you're talking about chart crimes, and then also like what's actually underlying that movement is what you have to pay attention to. And then third, I have a question for you: is like high yield spreads, etc. We always use historical analogies, analogs. Sorry, and it always bothers me. Is like, do you think even the high yield spread is dramatically changed by movements of the Fed, from 2008 to now to 2020 to now? Like, is that really a good way for us to measure market risk?
Well, you have to ask about the composition of the high yield bond market, right? It's very energy driven. And so you might ask, well, why isn't the high yield bond market moving? Well, if commodity prices and oil prices are through the roof and you've got record profitability for energy companies, and energy companies are a huge part of the high yield bond market, like that composition alone may make it an irrelevant point towards the health of the broader economy, right? It's just like it's a weird index composition issue. To your point about the Fed, I don't know. It's sort of, is it a pre-2008 spread analysis versus current spreads and saying, hey, there's this embedded Fed put and therefore spread should never blow out as much? Maybe. But I still think you can say, look, spreads at 200 basis points are meaningfully different than spreads at 500 versus spreads at 1100 basis points. Like you can still say the market is demanding a premium for the risk it's taking. And right now, spreads are pretty tight still in high yield, and they really haven't moved much.
I can show a chart illustrating this, Corey, if we can see this. Oh, shoot. Okay, actually. Never mind. Keep talking.
Okay, yeah. Jack. Yeah, so anyway, so if, what people were plotting was HYG. If they plot the ticker HYGH, what you have is an interest rate hedged high yield bond. So it literally holds HYG and then shorts a duration equivalent amount of treasury futures, I believe, to neutralize the duration sensitivity. And that's going to be more pure credit exposure. You can also look at floating rate bonds like CLOs, that sort of stuff have not moved much this year. And you could also look at the credit default swap market. And this is where I definitely start to get a little bit out of my depth, because my understanding is a lot of that market is fairly illiquid. But if you were to plot sort of credit spreads in the high yield market, they are sort of going down lately, versus you were to plot like aggregate CDS prices, they've been starting to tick up a little bit. But I don't know how much of that is, again, due to the composition of, the CDS index itself. I don't know how that basket is truly made up from a sectoral perspective. And I don't know how well it prices from a liquidity perspective. I hear that like the single names on CDS have become very illiquid in the last couple of years. So that's just sort of hearsay from me.
That's a great point. And along those lines, Verdad puts out weekly research, and their research this week was about, bonds in a rate hiking environment. Are they a terrible play like everybody thinks it is? And they were trying to say not so fast. One, they're trying to show this is like the 5th worst drawdown in the 10-year historically. And but by the way, we're recording this on April 14th. I think the 10-year's moving down again today, so might be getting into like the 3rd worst drawdown in history. But what they tried to show is going back to the 1950s with rate hiking cycles, how bonds and other asset classes have done. And then specifically looking at 1970 to 1982, in nominal terms, I think it was like bonds were up 4%, and then with a 19% drawdown. Meanwhile, stocks, once again, in nominal terms, were like -6% with like a 43% drawdown, if I recall correctly.
Yep.
And so they're trying to show just on a drawdown basis that, the 10-year wasn't as bad as maybe equities or as people would imagine, because at least you're still getting that return, like you're talking about, that football-like return of at least getting some income. And so they're saying, yes, it doesn't keep pace with inflationary environments or rate hiking cycles, but it may not be as bad as a lot of other asset classes. Is that like a fair assessment, or how do you think about it?
So I read this one earlier this morning. I was catching up on some emails, and there's three things that came to mind. One, the gentleman who wrote it, Greg Obenshain, is a bond manager.
Yes.
Now, Greg's been on my podcast, very smart.
Yeah.
But like, again, let's just talk about the reality of it. Like, you're not publishing research most of the time that doesn't agree with the product you're selling, right? He's a bond manager. Probably the big question they're getting right now is, oh, we don't want fixed income because of a rising rate environment. He's trying to publish research that supports fixed income in a rising rate environment. So let's like just start with that acknowledgement of potential bias in this research. There's sort of in two places I go immediately. The first is, it's a little weird to me to compare drawdowns across asset classes that are very different risk levels, right? Like the 10-year U.S. Treasury has a very different volatility profile than the S&P 500 does. If I said to you, hey, in a rising rate environment, 2-year Treasuries didn't have as big a drawdown as equities, like, would you be surprised? It's sort of true for almost any rate environment, whether up or down or sideways. So, like, first start, I don't like the analysis from that perspective, because I get that you're measuring max drawdown, but I think you have to acknowledge the drawdown relative to the usual volatility profile of that asset. Like, is that a meaningful drawdown? And I hate to use like in standard deviation terms, because obviously, 6-10 sigma events, like, don't misinterpret that. But I think you have to normalize in some capacity for the latent risk that's embedded in that asset class anyway. And then I know this is a thing you hate to talk about, Jason, but the real versus nominal still remains a difficult conversation when you talk about drawdowns, because yes, treasuries in the 1970s and 1980s actually, from a nominal perspective, didn't have that big a drawdown, largely in part from the huge coupons that they started earning in the back half, right? Like, as rates were going up, those bonds started distributing more income. So if you talk about a constant maturity or constant duration bond index, you're rolling into new bonds that have a higher and higher yield. It's one of the things that, like, when people talk about losing money with bonds, all interest rates really do is like push and pull cash flow from the future. And so when interest rates go down, you're taking future coupons and sort of realizing them early. And as you roll, you'll get smaller coupons in the bonds you roll to. And when you increase interest rates, you're going to sort of push coupons into the future. So you lose value today and you roll into bonds with higher coupons. So that's all interest rates are really doing from like a fixed income portfolio perspective. So again, you see this feature where nominally rates bond indices didn't do that poorly during the super high inflation era of the 70s and 80s. But in real terms, they did really poorly. But again, it goes back to your question of how do you measure real? What is real?
Yeah. Well, and I think in defense of their article too, is like in comparisons to equity markets too, like how did they do in real terms? Like even worse. So it's like clean as dirty shirt kind of argument. But I agree with you, and we'll get to this later actually more with real versus nominal when we start talking about commodities and everything. But another reason why I hate historical analogs is like there's a lot more going on than people realize, and there's different levels of this game. And even Jeff Curry brought up, and we'll get to that podcast later, is the idea during the 1970s as well, is like you had a savings glut, like globally, and you had the recycling of that money that was, flowing to oil producers. They had nowhere to put it at the time because they're getting hundreds of billions of dollars. So they were recycling it back into treasuries. So did that, create a different environment for treasuries in that scenario, where nowadays, they will take those hundreds of billions of dollars and put them into infrastructure products in their home country instead of probably recycling them into treasuries because that was the only option at the time.
And that's super counterintuitive, because you think if there's a savings glut and people are buying tons of treasuries, that would push yields down. But it didn't.
Right. Well, and it protects against that drawdown though too. Is I'm thinking more on the drawdown sense.
The question, Jack, might have been, if they weren't doing that, would yields have gone even higher? right?
Yeah, it's the classic yield rise during QE type thing. Jason, I have not read the Veridad piece. I didn't do the homework. I'm bad, but I did some work for a previous episode where I looked at the returns during the 1940s versus the 1970s for different parts of the Treasury curve, and from best to worst, they were, I think, short-term rates in the 70s, because as interest rates rose, they had low duration, so they could just constantly reinvest, as you say. Then the long end of the curve during the 1940s, because it was a fixed yield curve, so you wanted to get a longer coupon. Then I think, I actually forget which was the worst, but 1970s, the long end was really bad because it was so duration sensitive and rates rose so much. And then the 1940s, the short end was bad because rates couldn't rise to meet inflation because of yield curve control. So that's a little fun tidbit. I also have the chart, Corey, that we can look at. The yellow is the total return HYG so interest rate hedged high yield. So it's taking the interest rate risk out of HYG. And purple is HYG total return. So when people, and this irritates me too, they say, put a chart of HYG, maybe they have some trend lines and they say like high yield is the truth. What is the high yield bond market telling you? Implying that a credit rate risk is here. But most of the drawdown in HYG, at least year to date, is due to rise in risk-free rates, not due to a widening of credit spreads.
Jack, can you add IEI to that chart?
Yes, I can.
IEI being the I shares, I think 3 to 5 year U.S. Treasury. And yeah, I mean, you can see IEI in the blue there versus the purple. Obviously, the purple has some sensitivity to credit spreads. When credit spreads were dropping or rising in mid-March, you can see that the orange line went down, but the orange line is almost back to zero. The rest of the move has almost entirely been interest rates.
And Jack, I'm really glad you brought up duration and then also 1940s, because hopefully we'll get into a little bit later the idea of different forms of financial repression with like yield curve control and how that affects different asset classes. But one of the ones with duration is, Corey, you've talked about frequently, so I want to bring it back up to give you a platform, is the idea too, if you're trading, treasuries, bonds, notes, etc., you can, especially if you're using futures, you also have roll yield as well. So you might want to go shorter duration, leverage it up, and take advantage of roll yield as well. So I'll let you kind of speak on that.
Yeah, there's, I think, a couple of things, two points I want to make. One, to something Jack said where he was talking about the shorter end of the curve doing particularly well. Jack, I think he said during the 70s. I think one of the things, one of the good rules of thumb that I think a lot of people aren't aware of, but should be, is that for a constant duration or for a constant maturity index, like if you're buying an intermediate term US Treasury index, one of the really good estimates of forward returns is what's called the 2 times duration minus 1 rule. So if you look at the duration of that index, and let's say for an intermediate term Treasury index, it's a 6 today. So your duration is a 6, and multiply it by 2, so you get to 12, and subtract 1, get to 11. The current yield to worst of that index is going to be a really good predictor of annualized returns over that period. So over the next 11 years, you can look at the current yield to worst. So even though interest rates have gone up quite a bit, if you were buying an intermediate term US Treasury index today, you're pretty much locking in your return for the next decade, regardless of what happens with interest rates. Now, you might get some volatility along the way, but again, that's just the push and pull of returns into the future. Now, so when you start talking about really short duration, they can navigate a rising rate environment really well, because that 2 times duration minus 1 period is very short, right? Because what happens is, they get the immediate loss, but then they roll into a new bond that has a much higher coupon. Right? So you'll earn back that loss really quickly, versus when you get further out with a higher duration, it just takes a lot longer for those coupons to make up for those losses. And it gets much more complex when you start talking like way out in the curve, 20 to 30 year, because you have convexity issues that make that 2 times duration rule a little less useful, but it's still a good approximation. So that's one I think, I don't know why it's not more popular, but it should be in everyone's sort of lexicon and toolkit when they're trying to do some of this analysis. And then I don't remember at all what your other question was, Jason.
No. But no, part of that was, one, I just want to clarify too that you can make up quickly with the shorter duration, but you're still going to probably be trailing inflation or wherever it's at. Like, I mean, you're still in real terms going to be slightly trailing, but you're keeping up better than on the other asset classes, and you're keeping up better than being in long duration. And then I think there's just the little tiny part you missed was like maybe leveraging up that shorter term and getting the roll yield from trading the futures.
The roll yield. So this is another part that I think people don't look at a lot. So there's this idea that we've had this bond bull market for the last 30 plus years that was due to declining interest rates. And when you look at buying a bond index, and again, we'll keep it simple, like let's just say you buy a 10-year US Treasury index that every month sells its 10-year Treasury and buys the newest issued 10-year US Treasury. There's a couple of things that are going to drive the price changes month to month. One is going to be the income that you're earning. So your starting yield is going to be really important. And then the question is going to be what happened to interest rates over that month? Did the interest rates go up or down? Did you lose value in the bond that you bought? And then the third is going to be the bond you're selling actually isn't a 10-year anymore. It's a 10-year minus 1/12, right? And so what needs to get compared is to that point in the curve. And if you have an upward sloping interest rate curve, what you would find is that the bonds that are at that 9.87 point in the curve, or 9.92 point in the curve, actually might have been issued at a lower interest rate than one you will currently have, and therefore the price of your bond must go up so that they have an equivalent yield to worst. And so in rolling down the curve, you can actually have your bond price go up, and this is sort of an extra carry you can earn. Now, when you actually decompose where returns came from in the long run, over the last 30 years, it was not from declining interest rates. It was just from starting yields. Starting yields are the biggest driver when you hold long enough for any of these indices. But then shift in rates coming down was an extra tailwind, probably made up about 10 or 15% of the total return. And then this roll down yield actually made up another 20%, I think. So I think 75% was just from starting yield when I did the analysis. 10 was from shift, and then another 15 to 20 was from roll down. And that roll down can really accumulate for you over time.
And that's the best part about it.
By the way, it's
futures.
A built-in feature. Well, it's not just futures. It's a built-in feature of any constant maturity index. A total bond index, not so much, because it's holding everything through maturity. But if you hold like a 7 to 10 year US Treasury index, you're buying at 10, selling at 7, rolling to 10. If the interest rate curve is upward sloping, which it should be in most environments, you should be earning roll yield.
Right, not to geek out, but an upward sloping yield curve is sort of like a 10-year note futures curve in backwardation, and that's why you sort of get roll yield, right? By selling something cheaper and selling something more expensive and buying it more cheap.
Yes, I believe that is correct.
You went with a double negative on you just to see if you were paying attention.
Yeah. Jack, I haven't slept enough for a double negative.
With a contango yield curve and then a backwardated futures market, like how? What? Yeah, exactly.
Yeah.
And then so think about we've been talking about inflation and the bonds. So let's move to another asset class, and maybe I'm only paying attention because of the world I live in. Is we haven't heard much about commodity supercycle, but it's starting to kind of rear its ugly head. You're starting to see
this
that.
Is your
that
favorite topic? Preach.
Oh yeah, always. Yeah, no, I just one. Let me caveat because I will in the end. Like, are we about to enter a commodity supercycle? Are we in one? How long will it last? I have no idea. But let's just talk about what's been kind of going on in podcast land and in both of our worlds a little bit. And so a commodity supercycle, and I'll start basically with like my buddy Tim Pickering was on Top Traders Unplugged, and he was talking about the basics of a commodity supercycle are twofold. One, you need some sort of constraint on the supply side, which we've had in the last decade plus with like a lack of CapEx spending. And so that starts to kind of work through the system eventually. But like you said, then you need a catalyst to really kick off the supercycle. He referenced several catalysts, obviously the pandemic, ESG, build back better with infrastructure, and obviously a war in Europe, right? As we're seeing now that everybody's talking about. So those are kind of the starts of the way Tim was referencing it on Top Traders. But that's the typical way we think about a commodity supercycle. The other one that I thought was really fascinating was Goldman Sachs commodity expert Jeff Currie was on Odd Lots this week, and I think actually it came out today or yesterday. So obviously Corey hasn't had a chance to listen to it yet. But I like his way of presenting it was he called it the commodity volatility trap, and the idea that when we have like these commodity prices spiking, even on the producer or the banking side, they as volatility and prices expands, now they require more liquidity. And if the liquidity historically hasn't been there for the last 10 years, now everybody's searching for liquidity that can almost lead to like these short like squeezes. And so they're looking for more funding. And then if things like oil or other commodity prices, double or triple, now you need 4x or 16x the amount of capital because of the volatility is expanded or that distribution of prices is expanded. And so with a lack of, and that's to Jeff Curry's point, is he believes we're in a commodity super cycle. I don't want to put words in his mouth because of those effects. Corey, you want to jump in?
Yeah, no, I want to ask a question. So when you say require more capital, who's requiring more capital for that liquidity?
Either
Banks
producers,
require more
hedgers,
margin?
banks. Yeah.
Okay.
And well, the producers are quite, for the margin, and they're usually getting that margin from banks. So they need more. And then even on the production side, if prices are spiking even on their input costs, even though they're producing commodities, they're still getting prices spiking on their input cost of commodities to produce like the finished goods we need. So that's where it's expanding as well. So everybody need more capital across the space. And so he referenced
you have this sort of endogenous market feature, which is volatility is going up. You have to post more collateral, which is actually in turn driving more volatility into the space, requiring more collateral, but that's having very real impacts on the producers and consumers themselves, which actually can further the spiral. So it's a feedback mechanism, it sounds like. And again, I haven't listened to the podcast, so I'm asking
you nailed it.
It's a feedback mechanism that goes from the financial market into the real economy and then feeds back into the financial market.
Yeah, you absolutely, and without listening to the podcast, you just nailed Jeff Curry's argument. So that was perfect.
Don't even have to listen. Yeah. Great. Thank you.
And part of what I think is our general thematic issues, or maybe I'm being solipsistic because it's the way my thematic issues is just that yin yang, that oscillations, right? That we're always going from one market to the next. And so part of his argument, like that you just referenced, is going from an old economy to a new economy back to an old economy, right? Like over the last 10 to 20 years due to financial expansion or whatever you want to call it, like growth stocks, everything that's capital light has done incredibly well. Meanwhile, nobody was interested in once again CapEx spending in the old economy of like energy production, and now that's coming to rear its ugly head. And so we go through these expansions and contractions where we forget about the things we actually need to survive when the economy is booming and risk is on and everybody's happy, until it contracts, and then we worry about what food, shelter, and clothing again. And then how long does that last? Commodity super cycle, until we forget about that again. We go back to looking for asset light businesses that can produce capital.
So what was Jeff's view as to like how long is a super cycle?
They actually didn't get into that. That's a great question. And it almost brings up our talk before about transitory. How long is transitory?
Right.
But one of the things he did also bring up that I want to touch on, and you nailed it on the spiral, is also the structure of these markets. Going back to like the 50s and 60s, you had these vertically integrated conglomerates that would create long-term contracts for each other. And if anybody, didn't adhere to their part of the contract, then they took them to court, right? We got into like the 80s and financialization, and the banks started jumping in and being the intermediaries, once again, almost margin and leverage, where they would fund those long-term contracts, right? And then so now he's saying, are we, because of this liquidity constraint, is it possible that we could go back to the conglomerate model of these vertically integrated, energy companies that have, every part of the capital stack in there, including financing, and they're going back to long-term contracts? Because he feels, almost that you referenced earlier, on the, you really need long-term contracts to suppress volatility over the long term. As people, once again, as everything, volatility is a function of time and expectations.
It sort of ties into something I've been giving a lot of thought to lately with no probably coherent or cogent result yet, but this idea of a feedback mechanism into the real economy and sort of the wall clock time of the real economy's ability to respond, right? There are certain things in the financial economy that can be instantly spun up in a response, right? Like shares can be issued out of thin air by a company. Yeah, you have to register with the SEC and all that, do a shelf filing and all that sort of stuff, but it's much faster. But if you need to have a real economy response to a lack of a physical good and you need to build plants and train people, the response function by definition is going to be slow because molecules have to be moved. What you're talking about, going back to long-term contracts, I would love to talk to someone in the market that understands from a regulatory perspective, what are the hurdles to that sort of thing actually being re-implemented again? From a market's perspective, do you have similar, wall clock restrictions that's like, that might alleviate the pressure, but that's not a reality for true adoption for 3 years of what it would take to get that sort of contract through to approval at the end of the day. That sort of stuff fascinates me because as you start to see these spirals, the ability for the system to react in a counter-cyclical manner, is ultimately what alleviates the pressure. But sometimes you're just restricted from pure physical ability and time to do things. And so like the financial solution you lay out, I would love to talk to someone who knows better than I do about market structure and bringing those types of products back. How quickly can it be done?
No, I think you nailed it. And that's part of why, when you ask how long do commodity super cycles last, they tend to be at least a decade to a 2-decade time horizon because of actually what you just said, right? As we move from old economy, new economy, back to old economy, we're used to especially with the pandemic, like just-in-time manufacturing. And like you said, when we need real world goods, these things take time. But when you're used to the new economy where you can change things on an instantaneous basis, we don't know how to maybe think in those longer term cycles or time horizons. The one that it's also related to that, what he brought up that I thought was really interesting is with liquid natural gas right now with LNG, is everybody's like, we need to ramp up ports, productions and everything and service Europe with what's going on with Russia. His take on that was like, okay, normally that takes like 4 years, to your point, is like, if you cut out all the red tape, you're talking maybe 2 years. If you do wartime footing and really push it, you're maybe talking like a year at best, maybe 18 months. And his point was actually even more interesting is like, instead of bringing that LNG over to Europe, bring the manufacturing to the LNG base in the US. And it might be easier to build out the infrastructure to do the finished end goods right on top of an LNG plant than it is to take the time to build out the LNG infrastructure to put it on ships and take it over to Europe.
Well, and you also have to ask about, like, again, put yourself in an operator's shoes. Like commodity volatility and macroeconomic volatility from like a geopolitical risk perspective actually makes these decisions get delayed potentially longer, right? Because you say, okay, I'm going to start this project to help alleviate these commodity issues that are happening in Europe right now because of their relationship with Russia. But let's say all of a sudden in a month, Putin's been overthrown and Russia turns into a democracy. And you just started reinvesting in a multi-billion-dollar project. Like, that's a risk to you right now. That might seem like a far-fetched risk, but like, what if this war in Ukraine goes away? Putin goes, okay, actually, I'm going to behave myself. Everyone, you can have our commodities again. And Europe goes back to accepting the commodities. Commodity prices go down, and the net present value of your project or the cash flow goes way down. Do you then cut the project? And so these like multi-world reinvestment decisions are made more difficult unless, you might have to have governments step in and say, we're going to help subsidize this because this is better for us in the long term and we want you to do this. So there might be incentives there. Or you need people really convinced that the new status quo is going to remain status quo for a long time. Transitory is sort of dangerous in the sense that if inflation is sticky, but people continue to view it as transitory, they'll never build up more capacity, so it'll stay stickier, right? By the way, one of the things I've been hearing at this conference lately is that transitory never meant inflation was going back down. Transitory was really about the rate of change of inflation.
Yeah.
The transitory people are now changing what they meant by transitory, I guess.
Well, that, in their defense, like both are right? It's not that easy too. We're always going to change our definitional opinions to based on what happened and what was our priors before that. But you touched on something I really want to nail down is like the idea is like Jeff was bringing up too is like who's willing to spend tens of billions of dollars on a project that might take 3 to 5 years without knowing the macro environment. And this goes back to the idea of volatility. As volatility picks up, it's very hard to predict into the future. And that's why he was bringing back the idea of like longer term contracts, maybe between conglomerates, because to have a longer term viewpoint, you need suppressed volatility or implicitly a short volatility environment. But part of that, what you said, is also who wants to spend this money when he brought up ESG investing, right? Like if you just had to pay carbon tax, and then you could I hate DCFs, but you could take your DCFs minus your carbon tax, and then you could decide if you're going to invest in an energy company. But as soon as you have ESG catch hold of the mind share, and people are shunning these energy companies, like you said, and they have to put out the capex over a long-term time horizon, and knowing that everybody is philosophically shunning their corporations, it's like, why in the world would you get involved in that?
Right. Yeah, when your cost of capital is going higher and higher because people
exactly.
are selling down your equity, and that's the trend, right? So, Jack, going back to a question you asked earlier, what's one of the growing trends? ESG continues to be a significant and growing trend.
Right. I knew that was good. You were going to say that. Yeah.
Yeah. I mean, I sat and listened to a live recording of the Trillions podcast with Eric Balchunas. He was interviewing our friends, Perth Toll, whose Freedom Emerging Markets Index ETF actually just eclipsed 200 million. So congrats to her. Thesis there basically being, don't buy countries with a very low G. Now, she started that idea before ESG in the US really took off, but she was saying sort emerging markets by their freedom scores. What are human rights like? How much of an autocracy are these countries, and avoid autocratic or dictatorships? Then you had Jeremy Schwartz, who was also there from Wisdom Tree, who runs emerging market products that continue to hold China, and if he would hold Russia. Made a actually very interesting point about, from a fiduciary perspective, Russian stocks today. I'll get into that in a minute. But it was like this interesting back and forth of what does ESG mean? But clearly ESG is on the top of everyone's mind and is a massively growing trend, and arguably is going to have an impact on the cost of capital for countries that are not getting included in these indices, because their stock price is going to get pushed down.
And I think a lot of ESG on the environmental front is prohibitive and negative. That is, we're going to create a stock and an ETF. It's like the Russell 3000, except it doesn't have any oil and gas companies. It doesn't have any companies that emit more than X. So it's, giving money to Apple, giving money to Microsoft like normal, and then just excluding the others. I think that's very different than investing in early stage venture capital investments that actually create more efficient technology that are cleaner. And I think the former is somewhere where you can generate pretty much the same returns, because energy is only 3% of the S&P 500, and you can charge a larger fee because everyone wants ESG. It's now 70 basis points instead of 20 or 30. But I think it is definitely the latter, like the type of venture stage investing that Jeremy Grantham does. And there are a lot more examples. Maybe investments that are so unprofitable for such a long time that perhaps they should be conducted by the government. I think those are the things that are really going to jumpstart the electrification and greening of the economy.
The big debate around the former from an investing perspective, though, is ESG proponents argue there's actually a big quality bias with ESG, that it's a long-term predictor of excess returns because it's effectively companies that are more forward-thinking, they're more conscious in many ways, and somehow it leads to quality characteristics that would lead to outperformance versus dirtier peers. Good governance, environmental maybe less so, but social as well. Greater diversity within the company may be better for their innovation. So there's arguments from ESG proponents that in a way ESG can serve like a quality factor. Other people like Cliff Asness in the past have tried to point out that if everyone expresses a view like ESG as a preference, then those stocks are going to be bid up, and then there will be a premium for people who are still willing to hold sin stocks that should be earned through a higher dividend yield or buyback yield or total shareholder yield. So it's an interesting dichotomy here that's still being debated as to what does massive flow into ESG stocks ultimately mean for your returns? Can you express that preference without, lowering your expected return necessarily?
Well, and there's Vincent Deloiar's done great work on ESG, just showing, and I haven't looked at it recently, is like mapping it over tech stocks and tech returns is basically like ESG is basically looking for employee-like companies. So it really rewards tech stocks. And so when everybody's looking at this outperformance from ESG, it's really related to like NASDAQ 100 companies. And so is it an outperformance due to ESG or because you've been in tech stocks during a tech bull run? And I haven't looked at it in the last few months. So it'd be interesting to kind of look at that again. But then part of it is like, obviously with the rise of ESG is some form of Goodhart's law or perverse incentives always is like, we're going to need hydrocarbons to get to an ESG world. And so once again, that's what Jeff Curry's referencing is like, if you spent the last decade focusing on ESG and you didn't invest in CapEx of hydrocarbon companies, this is what we're leading to with this spiral on the energy side. And then that's going to force, some really perverse incentives or like Jack saying, maybe even governments have to step in. And then Corey, just because you brought it up, I got to take that side note. Please tell me you didn't get shout out to Perth, by the way. Tell me you didn't get swag from Perth because she's sending it to me, but you probably getting it before me now, so you're front running me always.
I didn't get any swag from Perth. I didn't know there was swag.
I asked, but I told her you can't give it to Corey. But so maybe she.
Wow. No, she didn't even mention that. No. Okay, but I want your opinion on something, Jason, because this is something Jeremy Schwartz pointed out, right? So when the Russian market shut down and there were massive sanctions, you had issues in the US with ETFs and fund companies that held Russian stock, which has now basically all been marked to zero. And you have, from a regulatory framework, potential pressure saying that you're not allowed to invest in Russian stocks anymore. So here's a question. You are a fund manager and you have a fiduciary responsibility to your investors. The price of these stocks has now gone from $1 to 2 cents. And you think that if you wait just a little bit, it's going to go up to 50 cents, right? So, but now you're being told, and from a pressure perspective, people don't want to invest in Russian stocks anymore. Hey, you need to get those out of the index. You need to get them off the fund balance sheet. Jeremy was saying he still feels like until he's told for an absolute certainty from a regulatory perspective he's not allowed to hold them anymore, he has a responsibility to his shareholders that he has to continue to hold those stocks because they're effectively free call options, that they're priced at zero right now, and it would do a massive disservice to his shareholders to get rid of them, regardless of optics around holding Russian stocks, versus other companies have already completely pulled them out. You actually can't sell them, but have completely pulled them out of the fund basket. I'm curious as to your thoughts as a fund manager, right, who has to think about fiduciary responsibility. How would you feel in this situation?
No, it's a great question. I think you nailed it with now they're call options, right? Because they're non-existent until like the market reopens, and then you'll see where they're priced at. And I think it's a really fascinating question that I think we deal with all the time. Is like, as a fiduciary, like our job is to make money, protect our clients. But we live in a world now where, for lack of a better term, I don't want to say it's as much as freedom of speech, is like you can invest it whatever you want. Because if your government says, we're embargoing any investment in this country, then, now you're at a conundrum. Like, are you gonna, you have a fiduciary responsibility to your clients, but if your business is based in America and they're telling you can't invest in Russia, like, what do you do? Like, and so this actually leads, I'm curious to your take on this. Is like, I don't know the answer. I think as a fiduciary responsibility, you should be able to go anywhere and do anything to protect your clients. And so related to that is actually Tim Pickering brought up in that Top Traders podcast is a lot of times CTA or commodity trend followers get bashed for like exacerbating price moves as speculators. And people are like, even in, I want to say in Germany, they don't even touch CTAs because of that. And they say almost like in an ESG sense. And like Tim's argument was that, well, actually, CTA trend following is the most ESG thing because we're only trading derivatives. There actually doesn't affect the underlying businesses that much. And therefore, what we're actually trading is commodity volatility. And we're suppliers of commodity volatility and price takers and price makers within commodity volatility. So that creates better commodity markets if producers can hedge because the speculators are there. But once again, I don't know. I'm kind of like on the fence about this argument in general. Like I can see the argument where speculators on commodities can exacerbate price moves, but at the same time, it's a derivative exposure where we're just like warehousing the volatility of commodities. And so I took it from your call options on, Russian equities to trend following CTAs and commodity markets. But I don't have a definitive stance on this. I can kind of see both sides of the argument.
I think we talked about this a couple episodes ago. The sort of idea of, especially when war broke out, Russia invaded Ukraine, CTAs did particularly well, and the question of like, was that war profiteering in sort of
Right.
perverse sense? And a lot of the conversations I saw happening on Twitter were basically saying, look, at the end of the day, the producers are going to set their price. Like it's not, the producers aren't driven by the financials markets. The financial markets are driven by the producers. If the producer costs more to take, the oil out of the ground now, guess what? Oil prices are going up. And so whether prices go up or down in the financial markets is really not quite as relevant to consumers or producers, other than the hedging impacts potentially, right? That volatility could be hard from a managing cash flow perspective for consumers and producers. And I could see a very valid argument there. I guess the question is having liquidity providers in a market, useful? Having speculators in a market, are they a useful source of liquidity that in the long run reduce the costs for producers and consumers?
Right, but it kind of flips, unfortunately, in commodity markets, right? Because trend followers are essentially price takers, because you're exacerbating the direction. You're not a mean reversion, liquidity provider. That's actually provided by the producers. But also, to your point, is like the producers are so massive that the speculators almost are irrelevant as far as the price moves. I mean, it may have a little bit of functionality there, but it's so irrelevant. The other thing that kind of came out of a lot of this discussion, and maybe this was Jeff Curry, if I remember correctly, is we may already be in a commodity super cycle. And this is what I think is interesting. So I was making both sides of the argument, but watch what I do, not necessarily what I say, is we provide CTA trend following exposure in our portfolios, right? And so and we use that to hedge inflationary effects and amongst other uses that you can have CTAs in your portfolio. And so once again, when we start getting this question, I'm like, I'm protecting my clients' portfolios from inflation. Right? That's my fiduciary responsibility. So I'm obviously in the fiduciary responsibility camp. But what has been interesting to me that was brought up, I think, by Jeff Curry is like, there's not a lot of investment into commodities or the CTA side, whether it's commodity index, et cetera. And what he brought up was like 2003 to 2006 was you already were in the commodity super cycle from 2003 to 2006, but institutions were performance chasing. They were waiting to see that baseline established. So they missed out on a lot of the moves from 2003 to 2006. And then institutional came in with a flood of capital in 2006, which actually, didn't work out too well as it plateaued from 2008 to 2010. But I'm just like, I'm curious, like, that's what I find interesting is like when CTAs are absolutely crushing it in the last 6 to 12 months, you're not seeing still a lot of people talking about it or a lot of allocation.
Yeah, talk about that clock time, right? How long does it take for committees to change direction? And I think this one is made more difficult by the fact that post 2008, there was a huge adoption of CTAs. And then CTAs went on and performed quite poorly relative to traditional betas and upset a lot of clients. And so prior to 2020, a lot of them had been cut from both institutional and financial advisor allocations. And so it's hard now to turn around and say, we know you had a really bad experience in this and we bought it and then sold it, but guess what? We're buying it again. I think it's like this is now a human behavior psychology issue of people saying there really is potentially no better way to hedge this inflation risk unless you go explicitly long commodities or you do some other weird basis trades. Like trend following historically, CTAs have had a phenomenal track record during inflationary periods or high inflation volatility. But I think I had this conversation with a number of advisors, like their clients hated CTAs during the 2010s. How in the world can they include CTAs again? A friend of mine, Andrew Beer, who runs the ETF DBMF, I was talking to him about it. They've had phenomenal performance this year. Their 3-year track record's great. They're just about to eclipse 100 million, I think. And like, those are all the things you normally see in an up and coming fund. And I said, you were just fighting the biggest uphill battle because you've got two things going against you. One, most managed futures within an ETF, like any of those that have been launched historically, have sucked. So the perception is managed futures doesn't work in an ETF. And two, managed futures as a category has sucked over the last decade. And so you're just fighting this problem of people had it, they hated it, they sold it. Now they need to reconcile that they might have to buy it again.
Corey, how much of that sucking of CTAs is due to just commodities being in contango and you're paying roll yield rather than receiving it? Or is that just not super applicable?
That's if you're long only in contango, like you're not thinking about the long short, and you're taking, there's different term structure plays. It's not as they're not as one-sided. There's a broad swath of the way you can run a CTA trend following program, and you can take advantage of term structure or fight against it.
Yeah, a lot of the studies that got published towards the ends of the 2010s trying to reconcile the performance. And by the way, I should mention, like, a bad decade for trend following was right, like,
or like up 2%, like that's crazy.
Yeah, it's hard to not call it my desert island strategy. Honestly, if I can only take one strategy with me, like, it's hard when the worst decade is it's flat. Because, by the way, don't forget, the prior decade U.S. equities were flat, so allowing something to have a flat decade seems okay to me. But a lot of it seemed, Jack, to come down to the fact that there were just, if you try to measure a trend, right? So if you were saying, look, on average, these are intermediate term trend followers, they're, using 6-month moving averages or something like that, you need, sustained trends of 6 months plus for them to be profitable. And the number of those trends measured across all the different futures markets they trade was significantly lower than it was in the prior decade. So, trend following is hard when there are no trends. So the question became, did the markets fundamentally change, that there weren't going to be any more trends, that it was now a mean reversionary market? That's a big philosophical question. Well, it's sort of proven in the last 2 years that trends came back with a vengeance.
Yeah. And this always happens every time, like, CTAs go through, like he's saying, like a flat decade. The question has always been, are trends dead? And then it always just comes roaring back.
Like, I mean, again, if equities have a bad decade, should we just be asking, are equities dead? I mean, maybe in the case of Japan, the answer is yes. But, like, again, the U.S. had a flat decade, point to point, from the 2000s through 2010 or so.
Yeah. CTAs, for people who don't know, is commodity trading advisors, I think. Yeah. And also, that 0% sounds actually pretty good. I'm, not really familiar with CTAs, so I'm comparing it to ETF commodity future strategies such as GSG, which was down like 88% peak to trough.
That's just long
buy
and
hold.
Futures. Yeah, that's just buy and hold. If you look at like the SocGen CTA index, I believe it was up 20% total. So like over the whole decade, plus 20 percentage points, which obviously isn't great when you talk about the S&P 500 being up like several 100%. But again, like, there are other decades that equities have been flat. So when you're talking about diversification, it's historically been something that's added a ton of value to a 60-40. It's just tough to stick with because it's more of a hedge fund beta. And particularly when you're an advisor communicating with clients, that can be very frustrating.
Right. And I'd also add that, Corey, you asked Jason, does Jeff Curry, does he specify on the duration? Yeah, the term supercycle, it sounds like it's a 10-year, 20-year thing. But you can have brief spurts of commodity price inflations in 4 to 8 years that you can still make a lot of money, that they don't have to last that long. Like, like 1916 to 1921, like that would have been a very good year to invest in commodities. 2003 to 2008. It doesn't have to be like a 20-year thesis.
Yeah. Well, and also what Corey's referencing too is like people have gotten burned. Like, if we're honest about it too, there's been a lot of talk in the past about commodity super cycles, and this is why people get burned. So it doesn't mean just because people are talking about it, it's going to necessarily happen. And Jack, I'm glad you brought up some of like just the index ETFs or whatever for commodities. And Corey, I know I could just anticipate what's going to happen in your mind when I bring this up, but like Resolve just had Antti Ilman on, and he brought up something about even the commodities world, as we always talk about, people always reference commodities are a zero return, but he was interesting. He showed if you held a basket of commodities and rebalanced, you would get that rebalancing premium due to that volatility. You'd probably make anywhere from 2 to 4% annualized just on rebalancing a basket of volatile commodities and having the correlations that are not as correlated as other asset classes.
Yeah. So the question is, which indices are actually doing that? I haven't. Yeah. I started watching the episode. I haven't finished it. I'm really excited to watch that. Everyone should check it out. Antti wrote sort of the Bible on quant investing called Expected Returns. He just released a new book. It's phenomenal. He does an interview with Adam Butler, friend of the show, that everyone should check out. But yeah, I mean, again, you look at something like GSG, which I think is the Goldman Sachs index, if I'm not the GSCI. and I don't think that rebalances. Like, it rolls, right? But it's not rebalance. It's just market weighting. I also think this is a case where, like, we're in 2022 and commodity markets are easily accessible. It's worth remembering that in 1995 there was no commodity index. That's when Goldman launched their commodity index. It really wasn't productized till the early 2000s. And one of the things you saw was that as institutions plowed money into those markets, it changed the very structure of those markets, right? They're all buying the front month contract. So all of a sudden you saw front month being bid up relative to later contracts. And you also saw volatility spillover because it became an asset allocation, part of the asset allocation. So at the end of month or whenever these firms rebalance, if they were up or down relative to equities or bonds, you saw capital slosh back and forth, which can start to enforce correlation structures between asset classes when you're getting these rebalance trades. So really interesting to think about. Commodities became unfashionable. If they become fashionable again with CTAs and they become fashionable again in a passive form, does the trade eventually become commodity congestion trades, sort of spread trades where you're shorting the front month and long a back month type trade? I wonder, I don't think we're anywhere close to that yet being attractive again, but if you start seeing your average person put 5 to 10% of their portfolio in commodities like they did in 2007, I think the trade then becomes, this is now congested, the front month is being overly bid up.
Yeah, part of that, I think, like you're referencing in 2007, 2010, is like these are fairly inelastic, like capacity constrained markets. So when you have large amounts of capital flows in, like there's nowhere for them to go. And so like that's part of it too. And that's why, once again, like you're saying, using historical analogs aren't the best move. Where I wanted to try to like kind of tie this up, and I think there's a way of doing this that gives a nice bow of like a lot of the issues we've been talking about on this episode, was Diego Perea was on Jesse Felder's Super Investor podcast. And one of the things I want to draw out of there that I thought was interesting that Diego said is almost like levels to this game again, is for most of our careers, everybody's just trying to produce nominal returns. That's how everybody talks about, is just nominal returns. We haven't even talked about real returns. So then that's level one. Diego's saying level two is now people are going to have to produce real returns after inflation, which we haven't had to do for like 40 years. And then level three would happen to produce real returns after taxes. And so I'm going to get into why he would say that. But what I love is actually Jesse brought up is he's like, you're number one with nominal returns. It might have been going too far. Let's go like 1A is actually producing returns relative to a benchmark. Like people weren't even worried about producing absolute positive nominal returns. They're like, if the benchmark's down 30 and I'm down 25, then I've done my job. So it's almost restructuring is like, you got to beat your benchmark, then you got to produce absolute nominal returns, then you got to produce absolute real returns. And now you're going to have to produce absolute returns after tax. I mean, absolute real returns after tax. And why we bring up the tax situation is that's what people aren't realizing is like part of what we could potentially see, and I'm not saying this is coming, is financial repression. And there's many forms of financial repression from, Jack brought up yield curve control in the 1940s. That's why I wanted to bring that back into the picture. You can also have obviously rising taxes in whatever country you're in. The ability to convert just even your returns into whatever country you're in and maybe get it back into your local currency, which people haven't had to think about in a long time. Other forms of financial repression are price and wage controls that we haven't seen since the early 1970s that people aren't thinking about. Like I was thinking about it at a the concept or conversation always comes up around. I talk to a lot of commercial real estate developers and investors, and they're really worried about a rising interest rate environment. And I'm like, yeah, that one's obvious, and you can hedge that. What you're not thinking about is financial repression, rent controls, etc., where you may be forced to basically lose money for the next 5 to 10 years because the government is imposing financial repression.
And then there's a soft form of financial repression, which we have already, where banks are required to own government securities that are yielding much less than inflation.
Well, and everybody could require to own government securities that are like, that's what's happened historically as well. Yeah.
Right.
So following here, was that a question Jesse was asking to Diego? Because I haven't listened to the podcast yet.
No. I thought Diego's representing.
I
added a lot at the end. Yeah. Sorry. So to go back, Corey, I just thought it was interesting. Diego's representing levels to this game from going like beating the benchmark to nominal to real after tax. And nobody's had to think about that for 40 years.
So I haven't listened to him talk about it. I did receive his email update where he talked about that concept. I'm actually not so sure I agree with that, right?
Okay, great.
Because the reality is, everyone is living in the real world. So you say you didn't have to generate real returns. Well, again, I'm tied, like 1A, if I'm tied to my benchmark and I'm just trying to create excess returns to the benchmark, my benchmark is going to do something relative to inflation that I typically don't have control over. Right? Again, 99.99% of mandates out there are not go anywhere, do anything. It's I am allocating to you as an allocator because you buy large cap exposure and you have a value tilt, and I want that. And do not stray outside your line because I'm building a portfolio of which you're just an ingredient. And if you stray too far, it messes up my risk allocation across everything else I'm allocating in. So as a portfolio manager, I don't really care about inflation because I have a mandate, right? From an allocator, like, and my mandate's relative to a benchmark typically, and the benchmark is going to have some sensitivity to inflation. It might be good, it might be bad, largely out of my control other than the initial choice I make. From an allocator's perspective, yes, I think that's where it matters, right? When you start talking about institutions who have to pay out, say, 5% of their money every year, and endowments in universities might be all of a sudden called upon for more cash flow because the cost of goods is going up or whatever it is. Yeah, I could see all of a sudden it being a very important question of, okay, we need to take into account the liability side. And I think that's maybe how I would frame it with what Diego's saying. Like, everyone always views it as from the asset perspective. All we do is talk about assets and investments, but all these assets exist and these investments exist because we have liabilities we need to meet. And a lot of those liabilities during an inflationary period become more expensive.
Right, especially if they're linked to inflation, like Social Security. I actually don't know a ton about like the private pension system, but if a pension system, if someone worked at Ford and they retired, if you're entitled to X amount times inflation, then you have to generate so much more return, and someone investing in a long-term treasury fund is not going to do well. Number one, because yields are going to rise, so they're even in the nominal world they're going to do poorly. And number two, they just cannot keep up with inflation. So it's a good point.
So I know there are cost of living adjustments, like COLA adjustments in public pensions. I don't know whether it's tied to CPI. I feel like that would be a very dangerous thing to do. Again, I'm just shooting from the hip here. I would presume it's maxed at a certain level. It might not be. It seems like if you suddenly said these pensions have liabilities that are tied one for one to CPI changes, like, yeah, you're going to have to see allocators making some dramatically different investment decisions. And perhaps that's ultimately the point Diego is making.
Right. And you're saying from the allocator's perspective, but I'm curious of what your take would be. Like you're saying, you have a mandate and a benchmark, and that's worked for the last 40 years. But like, if we continue along this environment we're on, I'm not saying we are, but if we do we start getting rid of this benchmark idea, and then fiduciaries have to have a broader swath of investing vehicles?
Well, I guess the question is ultimately, whose job is it to create returns in excess of inflation, right? I invest, let's just keep life simple. Let's say I'm a large cap manager and I'm picking large cap stocks. At the end of the day, those stocks are tied to businesses. And those operators of those businesses are the ones who are being impacted by inflation and the cost of goods and the prices of what they're selling. If they are able to grow at a rate that is higher than inflation or equivalent to inflation at the very least, then their share prices are going to become desensitized to inflation. So it's not even something I have to think about, right? So if the operators of the businesses on the ground are actually dealing with it from a revenue growth perspective, then it's not something I have to consider. Now, if you want to say, I have a view that there's going to be inflation in the short term, and companies that are less sensitive to inflation, have lower inflation betas, are going to outperform their peers, and I want to make a tactical bet, sure, that's different. But I think if you're talking about prolonged periods of high inflation, I think at that point, it's a downstream problem that needs to be fundamentally fixed, not something for the portfolio manager to try to navigate around for allocators. But
tying back in our previous argument, though, what if you're now under ESG mandate, so you can't even allocate to like hydrocarbon energy companies?
Yeah, and that's a problem, right? I mean, you look at energy companies are what, 3.5% of the S&P 500, right? It doesn't take a lot to be overweight energy companies right now, but they're really not having a huge impact from a total return perspective anymore, despite the fact it's done phenomenally well this year. And if people are allocating away from energy companies from a preferential, ESG perspective, they're potentially taking out a massive diversifier from an inflation perspective, right? Materials, industrials, some consumer staples, energy. Those are the sorts of basket of stocks you would probably want as an inflation hedge, and ESG may be very much short inflation as a concept.
Yeah, I would love that. Jeff Curry said it so succinctly on the podcast too. He brought up like nobody needs to own equities, but everybody needs to own the physical commodity. And I thought that was such a succinct way of putting it. Like whether people buy gold miners or energy companies or everything, like you can be entirely wrong on that single equity as far as the commodity supercycle and the boom of the underlying commodities. And I thought that was such a great way to put it. It's like nobody actually needs to own the equity, but people definitely need to own the physical commodity. And Jack, did you want to jump in there? Something you want to say before we wrap up?
Yeah, I just think our final, we're running pretty long. Our final topic, or maybe we could hold it for next week, is Jason. You think we're in the golden age of macro? Why do you think that?
I can tie that up. I put that in the notes because I don't necessarily believe it, because you know how I generally feel about global macro. But people like Russell Clark, et cetera, have said if you're in that inflationary environment, if you're moving back old economy from new economy, et cetera, then this is an environment where global macro guys should do well. Almost like Corey was saying, like it's been a dearth for CTAs over the last decade. Same for global macro. Because once again, you're looking for people that can actually assess individual, commodity, equity, asset class risk and allocate accordingly. Now, will they be right given their own idiosyncratic narratives is a total different topic of discussion, but at least people can now be picking individual and expressing those opinions versus trying to beat a benchmark. And so that's where they should excel if we see a continuation of this market.
Yeah, I mean, interest rate volatility, generally good for macro people.
Yeah. Corey, you good?
I'm great.
I can't wait. You got to get, like you said earlier, you got to get an IV injection. But
Yeah.
we thank everybody for sticking with us on this recorded one. We definitely prefer the live. Next week we'll be back live at 3 p.m. Eastern as we normally are. Once again, well, I guess if you're watching, you can see our Twitter handles. But if you're listening, I'm at Jason Mutiny. Corey is at C Hoffstein, and Jack is at Jack Farley 96, all on Twitter. Don't forget to like, subscribe, comment. We really appreciate it. Once again, the show is for entertainment purposes only. None of this is financial advice. Go ahead, Jack.
Yeah, just so normally people say this is for information purposes only, not investment advice. Jason, you're going a step lower, saying this is not even information. This is entertainment.
No, and not only that, is not even for entertainment purposes either, because I've seen your comments. And if you're worried about our solipsistic rambling, this show is definitely not for you.
I was going to say there's a lot of people who are not entertained by this show. So
this show is meant to challenge you.
Even sure.
This show is like The Wire, it's not like The Big Bang Theory. It's not for everyone.
I thought it was just an edifice to Corey and I's egos.
Yeah. We punish the viewer. Alrighty, guys.
Thanks, everyone.
Thanks, everyone. Have a great weekend. Don't forget to subscribe to the Blockworks YouTube.